Most investors are trained to chase the upside, but lenders are trained to survive the downside. I spent years on the credit side of the table, underwriting commercial loans, stress testing assumptions, and participating in credit decisions where a single mistake could cost hundreds and millions of dollars. That experience permanently reshaped how I think about risk, capital, and stewardship, especially when advising family offices and their family enterprises today. So, in this video, I want to share the most important lessons in risk that I carried with me from lending into my investing and advisory work. Why the lender perspective is important in this situation is key to understand. Lenders do not get rewarded for optimisms, they get rewarded for discipline and protecting the principal. When you sit in the lender's seat, you learn quickly that strong markets do not save weak decisions. Sophisticated models do not offset poor structure, and that capital preservation always comes before maximizing returns. For family offices and business owning families, this mindset is essential. The goal is not just growth, of course, that's important, but continuity is even more so. So, lesson number one is that people and character come first. That's one of the earliest lessons that I learned as a lender, that people and not properties repaid loans. I reviewed many deals that looked strong on paper but were ultimately undone by poor judgment, misalignment, or lack of integrity at the leadership level. So when I evaluate investment opportunities today, I always ask, does this person do what they say they will do? What is their character? How do they behave when things do not go as planned? Have they navigated adversity or only favorable cycles and up cycles? This applies to operators, executives, partners, and family leadership alike. Lesson number two is understanding the business model and not just the pro forma. Cash flow is not theoretical, it is operational. And as a lender, I really had to dig deep, peel the onion, and clearly understand how is revenue generated? What assumptions does cash flow depend on? And what breaks first under stress? For family enterprises, this means going beyond just the financial statements, which are important, but also asking what does truly drive earnings? Where is operating leverage hiding? And how sensitive is cash flow to disruption and exogenous events? If you cannot explain the business model in plain English, the risk profile is likely higher than assumed. Remember Enron? Lesson number three, risk must be identified, understood, and mitigated, but never ignored. Every deal has risk. The issue is whether it's acknowledged and addressed upfront. In credit underwriting, we explicitly ask, what can go wrong? How likely is it? What does a downside scenario look like, and what protections do exist if that happens? If risk cannot be mitigated through structure, reserves, diversification, or governance, it must be consciously accepted, not glossed over. Hope is not a strategy. Number four, collateral is a backstop. It's important, but it's not a plan. Collateral exists for situations where things are maybe not so great, but lenders know this truth well. Liquidation is slow, it is costly, and it rarely makes capital whole. So family offices should think the same way. What is the true downside value? Am I comfortable with what I see? Who else has claims on this asset? And how does liquidity change under stress? So if collateral is your primary protection, the risk is higher than advertised upfront and must be clearly understood. Structure must match the business model is number five. Many losses I witnessed stem from structural mismatch, short-term capital funding, long-term assets, aggressive leverage paired with volatile cash flow, and good structure buys one time, absorbs volatility, preserves optionality, provides early triggers for people to come to the table. Bad structure forces decision at the worst possible moment. And this lesson applies across investments, operating businesses, and family balance sheets. Lesson number six entails monitoring reality against expectations, actual against pro forma. Lenders don't just underwrite once and move on. They monitor, they evaluate performance versus projections, trend lines, not just outcomes, early warning signals that could bring everyone back to the table. And so family enterprises should do the same. Most losses do not happen overnight, they unfold gradually and then accelerate. So, drift from the original plan is information and should not be ignored, but instead should be acted for. And last but not least, trust your instincts. Some of the best decisions I made as a lender and as an investor were walking away even when the numbers worked on paper. Instincts matter when they're informed by experience, pattern recognition, and discipline. Listening to that internal signal helped me avoid multi-million-dollar losses. It's not quantitative, but it's an important one to acknowledge. And that clarity is built through experience over time. Lastly, losses matter more than gains. Every lender understands this math. It takes 100% gain to recover from a 50% loss of principal. Risk management is not just about chasing the highest return, it is about avoiding permanent impairment of capital. For family offices and family enterprises, this distinction defines long term success. And so, in closing, I'd like to share that the credit seat taught me that disciplined risk management approach, and that is one of the most powerful advantages that an investor or a family enterprise investor can have. If you would like a second set of eyes on a deal, investment opportunity, or structure, feel free to connect with me one on one and continue that conversation in an advisory capacity. And if this perspective was helpful, subscribe to the channel for additional insights on risk, governance, capital strategy, and family enterprise decision making.